All right. Good afternoon or good evening or good morning, wherever you are. Uh, it's time for another discussion or session on understanding the stock market. We started this series of understanding the stock market, and we've covered in the first session, we covered the general understanding of the stock market. We look at all the participants, we look at the history of the stock market. And that, in a way, kind of set the tone for other uh, discussions that we've been having on the stock market. Our second session was on fundamental analysis. And for fundamental analysis, um, as an investor, you need to have a good understanding of what fundamental analysis is, because that is where you actually understand the company or the companies you are investing in. It's like running the company or understanding how they run your company, because you are a part of the shareholders and you need to understand where the revenue is coming from, where the cost is going to, and how they have been managing your investment. Now, we will be looking at technical analysis. This is session three, and which is going to be the last session of this series. When I talk about fundamental analysis in second session, we're looking at investors who taking long-term view of the investment, people that are putting their money into a company and they are there for the long haul. They are there for 5 years, they are there for 7 years, 10 years, even decades. Uh, for you as an investor, fundamental analysis is very, very important. However, there's another group of people that are more concerned about the short term. They are not really concerned about whether the company is going to be around in the next 2 years or next 5 years or next 10 years. They are concerned about what the price of the stock of the is doing today. So they focus on the price. They focus on what the trend is saying, and it is generally believed that as a technical or as a trader, the general understanding of or philosophy is that whatever the company is doing is already factored into the price. So because of that, they are not really concerned about what the strategy is or what the future is for the company. They are concerned about what the company was and what it's doing today. So they focus on what we call the price action. And whatever the price is doing, they trade based on that, and they either make money or they lose money. So there are two groups of people. We have the investors and we have the traders. You can be both. You can be an investor and you can be a trader at the same time. But for you to be a trader, for you to be able to trade any stock, you need to have a proper understanding of technical analysis. The tools that you have in your kitty um, um, is the technical analysis. You can also combine it with fundamental analysis, but most importantly, you should or you will be using technical analysis to make your decision and to trade. So it is important that we understand what technical analysis is and how we can apply it to the Nigeria Stock Exchange, especially as small investors and small retail investors and traders. So looking at technical analysis, there are key or some key areas that I will actually be touching, which I summarize in four points here. The first is trading fundamentals. So we're going to be looking at what trading is all about. We talk about the trading, the swing, what is long, what is short, who are the retail traders, who are institutional traders. We just have a kind of a view of what trading fundamental is. We also talk about risk and account management. How do we set our risk? How do we manage our accounts? And what is it all about? Because trading is a risky um, exercise, and you have to understand how to manage your risk. In fact, your whole job around trading is managing your portfolio, managing your risk. So it's important that we understand the basis of risk and account management. Then we will look at technical analysis. I call it technical analysis toolkit. So under these, we'll be looking at what your market structure is all about. How do you understand the charts? We're looking at indicators and we're looking at strategies. And then we look at other uh, aspects of the strategies that are applicable to the Nigeria Stock Exchange. So I would say in 7 key things, what will we look at or what you will learn at the end of this session is about the market structure, is about the indicators, is about strategies, your risk and accounts management, how to find stock in play, step-by-step guide to trading, and how to use AI assisted trading, and then other general information. So without further ado, let's go or let's start um, our discussion. So trading is divided into two, or we have two types of traders. We have day trading and we have swing trading. We have day traders and we have swing traders. What's the difference between a day trader and a swing trader? Day trading is let me put it this way. A day trader is someone that has to take a position and close that position within the same day or in the same day. A day trader cannot carry his position to the next day. He has to close his position that day. It's usually very fast. Day trader can trade anything. They can trade a stock that is going to close tomorrow, that will go bankrupt. They can trade a stock that is just starting. But the bottom line is that whatever position they take, that they open, they have to close it that day before the market closes, even if they are going to take a loss. So they will not be sentimental as to not wanting to close the trade if the trade is running at a loss. Rather, they will close the trade that same day, even at a loss. And this requires you to constantly sit in front of the screen to be monitoring the trend, the news, and making adjustment to your position. That's a whole lot of work. But the next group of traders is the swing traders. Swing traders don't necessarily have to close their position same day. They can take their position to the next day, across the weeks, even to a full month or more than a month. So they do what we call a multi-week trends. They focus on stocks that have some fundamentals, that they are fundamentally sound, because they are taking their risk across days and weeks. So they have to ensure that the stocks that they are trading still has some fundamentals. So they look for fundamentally solid companies. Their position can be held for days or weeks. And I would say, looking at Nigeria Stock Exchange and all the other conditions set in place, it is more suitable to be a swing trader on Nigeria Stock Exchange than a day trader. And so we know what a day trader is, and we know what a swing trader is. And most of us, or some of us that want to venture into trading, will likely fall into the swing trader category. Okay, so when they say someone is buying long or selling short, if I say I'm buying long and I'm selling short, what does it really mean? Buying long means that I'm taking a long-term position. Long-term in this sense means I believe that this stock is going to rise. So I want to take advantage for that long position. So for example, if I say I think Zenith Bank will rise, so I will buy it now. So I bought as let's say I buy 100 shares of Zenith at 125 and I sell it at 130. I've just 100. So that means I'm taking a long position. But when I say I'm selling short, it's like the reverse of buying long. You know, technically selling short means that you believe that this stock will likely fall. So you're going to borrow against it from your broker if it's allowed. Then you buy that stock. And when the stock falls, you know, you buy the stock back at a cheaper rate and return the stock back to your broker. That way you make a profit of 500. But in Nigeria, short selling is really, really not visible because most brokers don't allow you to borrow stock or shares from them. So in our case, we can say that when you say you are selling short, it just means that you want to exit at a high point, then re-enter at a low point. So you will be hearing traders talking about buying long, selling short. What it just means is that when I'm buying long, I believe that the stock is going to rise. I'm going to make a profit on uptrend. When it's selling short, I'm going to buy it at a cheaper value later, and I'm still going to make profit in the process. Now we have retail and institutional traders. These are the two types of traders that you have in the market. You have retail and institutional traders. So what's the difference between a retail trader and an institutional trader? A retail trader is someone that is trading with his own money. He decides what to buy. He has no obligation to act. His goal is to reach profit. All right. Those are the traders. Well, institutional traders are big organizations that trade huge volumes. They have sophisticated algorithms, computer AI to help make their position, and they generally move the market when they come to play. So many of us are retail traders, and we have small volume to buy, or we buy small volume. We don't have all the capital, but institutional traders are those big guys that can buy in volume. There are also high net worth individuals that can buy in volume, but oftentimes they buy through companies or through institutions as well. Now let's look at the trading platform. We all have our brokers. We have um, different brokers that will use their platform to trade. And on those platforms, you will see volume, you will see the other types, you will see live stocks, you will see the bid and ask codes, you will see charts, you will see portfolios. So those are some of the things that you have to have on any tool or platform that you are using. You must be able to see the volume, you must be able to see your chart, or you must be able to manage your portfolio. And let me explain what we mean by spread. Spread is just the difference between bid and ask. So bid is what buyers want to buy. Ask is what seller want to sell. Sometimes we call it offer. And so the difference between what the buyers are bidding and what the sellers are asking for is what we call spread. And spread is like your profit anyway. So looking at buy and sell orders. So what's a buy order? What's a sell order? So when you're buying, you can buy at market, you can buy at limit, you can buy at stop. So what is the difference? Buying at market simply means that you are buying at the price that the sellers are asking for immediately, which is like the average price in the market. So when you enter into the market, you see someone that wants to sell a stock at a particular price, you buy from the person, that's market price. Even if you give your brokers instruction to buy at market price, they will just buy at any available price that they think it's okay in the market. Limit buy means you want to buy at a specific price. You want to choose a price, and when the stock gets to that price, they buy it for you. If it doesn't get to that price, they won't buy it. And stop buy means that you want to buy when price break a particular level. Yeah. So we have same for sell. We have market sell, we have limit sell, we have stop loss sell, and we have take profit sell. That is where you set the price at which you want to take your profit. Some of these might not be available on many of the platforms that we use, but we do have market price, we do have limit price in Nigeria. Some you might have to send instruction to your brokers to actually activate some of these kind of orders. Now we are getting to the main part of technical analysis. And the first part we look at is market structure. If we have an understanding of market structure, you have an understanding of indicators, and you have an understanding of strategies and how to use AI to assist you, you can be an effective trader. Trading is not that complex if you understand all the terminologies and what you want to do. So, and my objective is to open our eyes to the key things that we need to understand and build on that to be able to make an effective trade. So the first part that I will be looking at now is the market structure. So what's the market structure? It's just the pattern of a particular stock. If you are looking at any stock, say Zenith Bank, GT Bank, whatever pattern you are seeing on the chart is showing you the structure of that market. You can look at the entire market, Nigerian stock market as a whole. Whatever you are seeing on the chart is a structure of that market. And that structure is the natural cycle of how prices move. Every time you see a price chart, it's actually psychology and individuals behind the price. The price is not just algorithm. Those are rational individuals at different locations at different points making decisions as to what they want to buy and what they want to sell. And the aggregate or aggregation of their decision is what forms the market structure. It shows how who is in control, whether it's the buyer that is in control, the sellers that is in control, or there's nobody in control. So when you look at any chart, when you open you pick any stock and you look at its chart, there are three faces that you will see on any stock chart, any stock chart. You're going to see rally. Rally is upward movement of the price. That's uptrend movement of the price. The second thing you will notice, or you may notice, depending on the stock that you pick, is what we call consolidation. That is sideways movement. When the stock or the price is not going up, it's not going down, it's just moving within a limited band, then we say that that stock is in consolidation phase. And the third phase is the pullback or the correction. The pullback or the correction is basically when the stock is dropping in value. Pullback does not mean it's going to drop completely, right? It could drop slightly and still go back up. But correction, most times, pullback and correction simply means that it's just dropping in value. But when you have what we call a breakdown, that's when the price continues to fall. So you're going to see these three phases: the rally, the consolidation, or the pullback. So anytime you are looking at any chart or you are talking to other traders or other investors, you want to be able to state whether the particular stock is in rally, is in consolidation, or is experiencing pullback or correction. But now, when we look at the entire cycle, we can still break this entire full market cycle or the market structure into 7 cycles. The first is accumulation. That is when people are buying quietly. You see the chart on the screen. You see the accumulation side. That's when people are buying quietly. Institutions are buying quietly. Then we see the rally, which is the uptrend, when the price is peaking or is increasing. You are making new highs. Then you see the consolidation phase when the stock is really dancing around a particular price range. Then you see what we call a breakout. A breakout is when the shares leaves the average point that it has been and starts to move up or move down again. In fact, move up, we call move up, breakout. Then you have pullback. Pullback is when you have a temporary dip. Normally you have a distribution phase where people are taking profit. Then you have a breakdown. That's when the stock is actually going down. So these are the 7 cycles. So you can describe your market structure in terms of phase, or you can describe it in terms of cycle. So when you are talking about the structure of a particular stock, you can tell us whether it is in accumulation stage, it is in rally, it's consolidating, it has a breakout, there is a pullback, there's a distribution ongoing in the market, or there's a breakdown. All right, let's now talk about support and resistance. Okay, I can see your hand for me. Welcome. You want to ask a question?
Yes, I have a quick question before you go so far, if that's okay.
Okay, go ahead.
Yeah, I just wanted to get a kind of clarification. I see that when you look at the trend for accumulation and consolidation, it looks similar. So how can one tell in
Yeah,
between the two when is a market cycle is on? How do you differentiate when to know whether it's consolidation or quiet or the accumulation phase? That's my question. Thank you.
thank you. Good question. So generally, accumulation will precede uptrend, right? So when you begin to look at the pattern, we're still going to get into understanding candlesticks. But when you look at the kind of candlestick that is forming, right, you will begin to notice that, okay, the candlestick that is forming around this price is pointing to the price wanting to go up. You begin to see higher, new highs, new highs, new highs. Then you see a breakout. Then you know that what you had before that time was kind of accumulation. If you look at distribution as well, distribution looks as if it's also in consolidation. So it's a type of consolidation anyway. But in consolidation, people are not really taking profit. And I give an example of a stock that is currently in consolidation, and you might guess, you know, Access Bank. If you look at Access Bank, you cannot really say that anybody is taking profit or anybody is quietly buying, because when you look at the volume, when you look at the price range has just been moving between a particular fixed range. But
Mm,
if what you have, if a group of people or institution are actually quietly buying,
right.
it will show in the kind of candlestick that will start to form. And you can say, and this is where the skills of a trader comes, you can say that the next thing you're going to have is upward rally. So when we get to understanding the candlesticks, you begin to see the characteristics. But it's a good observation. Consolidation looks like accumulation and distribution in one sense or the other, depending on what happens after that phase. Right.
Okay, because
So
if you ask me
mm,
the example of access that you gave, I would actually say perhaps access is in the accumulation stage because the price literally is just being, it hasn't really changed. And if I look at for those of us that are small buyers, like we, the retail, uh, stockholders, if I can say that,
yeah,
it's we're actually more of the stage of just trying to accumulate and buy more because the price is really not changing. So if you ask me as somebody who is not so experienced with looking at these things, I would say, oh, perhaps access is an accumulation, not necessarily consolidation, because I have not exactly seen it in the past few years have any form of rally in terms of upward movement. I may be wrong though.
yeah, no, no, you're wrong, not wrong. So by the time we get into the meat of understanding the stock market or the technical trade, you will now begin to see that you cannot use one particular indicator to determine what is going on. So we
Okay.
now have to start combining, because now the next question I want to ask is what is the volume? So if you say quietly buying, there has to be some other indication that confirms what is happening. But
All
if the
right.
volume remains average, you are likely in consolidation phase. So let's
Okay.
just take it now that consolidation can look like accumulation or distribution, depending on what the volume and other indicators are saying.
Right. Thank you.
All right. All right. Thank you. Thanks for that question. Okay, so let's talk about support and resistance, because this is an interesting topic. Actually, technical analysis is very interesting, but once you understand all the terminology, it's going to be fun reading any chart. So on any stock chart, one of the things you want to look for is what is the support and what is the resistance. And support simply means that price point at which the price is turning back upward. That means is supporting the price. The price of that stock does not want to fall below that particular amount. That is its support. And resistance is that particular price point that the stock has not been able to break out from. Is resisting the price upward movement. So when the price is going up, it's trying to go into test a particular resistance. And the moment it breaks that resistance, it will want to look for another resistance. So if you look at this chart on the screen, Looking at this chart, this line was drawn on 110, right? That 110 looks like the resistance for this particular stop because every time it moves up to 110, it bounces back down. Then it goes back again to 110, it comes back down. Then it goes back again to 110, it comes back down. That shows its resistance is already formed around 110. But something happened around this side. I don't know if you can see my cursor. Can you see my cursor?
Yes.
All right. So something happened around this side when the stock eventually was able to break that resistance. That's what we call a breakout above resistance. Same thing happens below. Here you see that these stocks seem to be sitting around 90, right?
Hmm.
So that's a support. Anytime it moves and it's coming down, it bounces back from that support, goes back up like a ball, bounces back. That is its support. There's something happens here. It broke that particular support. That's we call it a breakdown below the support. That means there's going to be a downward trend. So when you see this kind of breakdown or you break out, you know that is that going to be upward trend or downward trend. And that gives you some information about what is happening in the market. So anytime we are talking about support and resistance, you see investors or traders talk a lot about support and resistance. Where are you taking your support? Where am I taking my resistance? It can be different for different people. This comes to how you're able to read trend, how you're able to draw your line. But there are some that are just kind of obvious. For example, there is a kind of support around 95. If you look at this 95 here, you can see a kind of support around here, but it's not fully formed. So you will still take support around 90. Okay, let me go to the next thing I want to discuss, which is risk and account management. We'll continue the market structure, but I want to talk about risk and account management because as a trader, your psychology is different from that of an investor. An investor is someone that quietly buys a fundamentally sound stock and allow it to grow, to pay dividend, and possibly to grow into the future. He or she doesn't need any stress. Just buy a good stock and allow it to grow or to pay dividend. But a trader is actively trading. It's like going to the market. It's like selling and trading pepper or trading anything. He has a target to meet, whether on a daily basis, on a weekly basis, on a monthly basis, you know. And because of that, it is important to understand how to manage your risk because you might not have all the capital. Maybe you just have £1 million to trade, or you have £5 million to trade. Those that are professional traders, they give them a portfolio of about 100 million to trade. You cannot waste the money. You cannot go and meet your boss and say, sorry, the account is empty. So there is a need for us to understand the risk and account management. So what do you want to know before you trade? The first thing is, am I trading the right stock? You want to be able to decide if the stock you are picking to trade is a good stock. The second thing is, what share size should I take? So if I have £1 million to trade, and I'm looking at First Bank, should I use the entire 1 million to buy First Bank? Should I use part of it to buy First Bank, buy Zenith Bank? So there is a way to determine how much shares you can buy. Then what is my stop loss? How much loss am I willing to take? Is a risk. There is risk to every trade. So how much loss do I plan to take? And it's generally advisable not to take more than 2% loss on your account. That means if I have £1 million to trade, I should not risk on any given stock. I should not risk more than 2%. Don't go and risk 100% and lose the entire money. All right. So having an understanding of what to look for, then the next thing you want to talk about is position sizing. Now that let's assume that I've decided to trade First Bank, for instance, I see there's a good stock in play. Later we discuss on how we determine stock in play. But I've decided that First Bank or Zenith Bank or whatever stock I'm looking at now is in play. And I have 1 million naira in my account that I want to use to trade. So how much of that stock should I buy? So your position size is total risk allowed divided by risk per share. So let's say, for example, in this, what I have on the screen, I have 1 million account size. That's what I have to trade. And I'm not going to risk more than 2%. This is what is generally advised. You can decide to risk 10%. It's your choice as a trader, but it's generally advised not to risk more than 2% of your trade. So that means I should not risk more than 20,000 naira maximum loss that I'm going to take on this particular stock if the market goes against my plan. Now, the next question you want to ask is, what is my risk per share? Assuming that this stock is currently trading at 10 naira. And in Nigerian stock market, your stock cannot fall more than 10%. And it cannot rise more than 10% in a day. So let's assume that I'm stopping at 10% loss. Now, which means I'm risking just 1 naira per share. That means if I buy it at 10 naira, it can drop to 9 naira. I'm willing to accept a loss of 1 naira per share. So what is my position size? My position size is total risk allowed, which is 20,000, divided by risk per share, 1 naira, making 20,000 shares. That means if I want to trade this particular stock, I'm just going to buy 20,000 shares at 10 naira, which is 200,000 naira within my 1 million naira account. So I cannot afford to commit more than 200,000 on this particular stock at a risk factor of 2% and a risk per share of 1 naira per share. Is it clear? Is that kind of clear?
I think
So
I get a sense a bit. So this means that with this, you're saying if we, let's say, for example, per time, I have 400,000 to
yeah,
trade Monday now, for example, and I'm trying to think, oh, I'm considering buying, let's say, Zenith and GTB.
yes,
Now, if I get this correctly, I will use the current price of, say, for
yes,
example, GTB, and I will do my risk per share, and
mhm.
and then I will use that to um then
So the first
feed.
thing you decide is how much of that 400,000 do you want to lose, or you can afford to lose. So let's say 2%, right?
Okay. Yeah.
So the 2% is 400,000 times 0.02 is what? 8,000 naira.
Yeah. So, but what I'm looking at is in a situation where the 400,000, I want to spread it on two stocks. So, because I'm thinking, if I do 2% of that 400,000, now when I want to do my position size, then,
Mm.
I would have calculated my risk per share based on the actual price of the stock I want to buy,
Yes,
which then comes into my calculation for my position size. So
yes,
that's what I am thinking, that perhaps if I'm using 400,000, maybe first I would have decided, okay, I want to use out of that 400, 300 of it for GTB, 100 for
no.
Zenith, and then I'll
So
use that to calculate.
so as a trader, that's not the
Oh,
way you trade.
okay.
It's different from as an investor. If as an investor you can take your 400,000 and say I want to buy 200,000 of Zenith, 100,000 of GTB, 100,000 of, okay. As a
Mhm.
trader, you must always have money in your pocket, in your account.
All
You
right.
can't risk all your money on a particular stock, no matter how juicy. That's why we talk about risk and account management. Trade can go against you because
Okay.
when I started, I talked about um, day trader and swing trader. A
Mm.
day trader has to close his position that day.
Right.
Whether the stock is making money or is losing, he must close it.
Mm.
But a swing trader can may not close that day. He can allow his position to stay for a week or weeks, right? But at some
Mhm.
point, depending on your trading plan, which we talk about later, if your trading plan is 1 month period, just take it as if it's your job, and you start first day of the month. Your job is to buy and sell, buy and sell, buy and sell. At the end of the month, you must tell us your profits, right?
Right.
That means you
Mm-hmm.
must close all your positions at the end of the
Mm-hmm.
month. You
Mm-hmm.
cannot afford to put all your money in one basket. Another opportunity might show up second week of that month.
I see.
right? So you
Okay.
must just decide, first of all, how much you want to risk. So let's say I decide I'm going to risk 200,000, 2% of 400,000, that's 8,000 naira. Then
Mhm.
Zenith or GTB is selling for 130, right?
Right. Mm-hmm.
And because it's selling for 130, um, when we get into other indicators, I will show you indicators that can tell you how to determine your risk per share. But for
Okay.
now, let's just assume that you are not ready to lose more than 2 naira, right?
Mm-hmm.
So
Mm-hmm.
you are going to sell, once it gets to 128, you are going to sell it off. If it doesn't
Mm-hmm.
increase beyond 130 at the end of the month, you are going to sell it. That means you are taking 2 naira per share,
Mm-hmm.
right? So if
Yeah.
I take 8,000 now divided by 2 naira,
Yeah.
right? That
Mm-hmm.
should give me about 4,000
Yes.
shares. But now if we take 4,000 shares, right? If we
Mm-hmm.
take 4,000 shares times times what? Times
The price.
the price, you see that it's more than your account.
Right.
Your account is about 520,000, right? So
Mm.
that means you cannot buy more than 400,000. You cannot go, it must be less or equals to your account.
Mm-hmm. Mm-hmm.
But it's
Mm.
still also not advisable. So if you have 400,000, if you have 400,000, I will
Mm-hmm.
not take a risk per share of 2%, right? I will increase my risk, my portfolio risk for that to maybe, let's say, something like 20%.
I
So
see.
that reduced me to like, let's say 800, right? Then I buy like 400 shares at 130, 130 gives me about 52,000 naira, right? So I can buy something like between 400 and 1,000 shares.
Mm. I see.
The whole calculation is to help you manage your money in a way that if the market goes against you, what you are going to lose is just maybe 800 naira or 8,000 naira, depending on what your total risk is.
I see.
But don't worry, when we get to the next stage in this
Mm-hmm.
presentation, I will show you how I use AI to actually do all that. You can use AI to help you do all these calculations,
Right.
because
Okay.
there's an indicator that will actually tell you, this one I just assume 10%. There's an
Mm-hmm.
indicator that will actually tell you what the price range has been over a period of a week, and use that to determine your risk per share. Not
Oh, so
just
the
you,
I
not
see. So
just I
the 10% is not a fixed
no, no, no,
percentage
no, no. I
that
just
is
use this
used in
one
the
for
market.
calculation. I just use
Okay,
this
okay,
one
okay,
for
okay, okay.
calculation,
I get you.
just to give us an idea of what position sizing is all about.
All
That is,
right,
all
all
these
right.
things can be automated. All right.
Okay,
So,
gotcha.
so because of time, let me speed up. So now, reading a candlestick. So when you look at candlestick on your chart, you will notice that some are green, some are red. The green ones are bullish, the red ones are bearish. That means the green one has opens at a particular price and closes at a higher price. And for the bearish ones, they open at a particular price and close at a lower price. So that means it's a loss, or the price is dropping. On the green, the price is increasing, or is a profit. Now, we also see that each candle has a wick, or what is called a shadow. Those wicks are just telling us different price point that existed or that have been tested during that particular period that you are looking at. Maybe it's a 5 minutes time or 1 week time, the highest price and the very low price. So whatever the size of the wick is also has a message or an information inside it, at a high price or at a low price. So anytime you're looking at the candlestick, you are looking at price actions that have happened. What is their opening position? What is their close position? What is the highest price that it has attained? What is the lowest price that it has attained? The size of the body of a candlestick also tells us what is happening, whether there is enough buyers that are playing, what is going to happen, whether the stock is going to go up or going down. Now we have bullish candles. We have different kinds of candles, right? I just generated this just to give us an idea of the key ones that we might want to get familiar with. You see, when you're looking at the candles as single candles, the first one here is bullish Marubozu. You have second one is Ama. The third one is bullish spinning top. we have long green candle, we have dragonfly. If you are looking at two candles together, two patterns, they also give you a particular message, bullish engulfing. That is, if you have a red candle of this size and immediately you have a green candle, that's what bullish engulfing typically is, engulfing the previous loss of the previous bear movement. We have the piercing line, we have the bullish Aramin, we have the Aramin cross, we have the morning stars. So as you get used to reading charts, you begin to see all these things pop up on the chart. Then you begin to understand what they mean. When you see a morning star, when you see an armor, when you look at multiple charts together, you can see that it's either forming something like an ascending triangle, inverse head and shoulder, rising wedge, bull flag, double bottom. All these are bullish signs that you will see on the chart. Once you see it, you know that, okay, we are going bullish on this particular stock. Similarly, we have bearish candle patterns. Same way you have the bearish Marubozu, we have shooting star, we have bearish spinning top, we have long red candle, we have hanging man. Hanging man it looks more like what, armor, right? But it's on the reverse side now. We have the same pattern, shows up here, descending triangle, head and shoulder. If you look at what we have in the bullish side, we have inverse head and shoulder. That means you have the neckline, you have the shoulders, you have the neckline, you have the shoulders, and you have the head upside down. That shows that we are going into the bullish trend. That means the trend is about to go up. On the bearish side, you have the head straight up, you have the shoulders, and you have the neckline. That means you are going into the reverse. So anytime you see all this pattern form on a chart, you can easily interpret it and say, okay, oh, this one is a bull flag, this one is a bear flag. Then we now have another one called doji. Doji is an indecision candlestick. That means at that point, the market has not decided. The buyers and sellers, they have not decided. They are still in a stage of discussion or fighting each other. And we have different kind of doji. We have abandoned baby top. You see the way it looks, just like a plus sign. We have long leg doji. This one has a very long leg, but the top is looking more like an abandoned baby, but it has a very tall leg, which tells me that possibly the buyers want to push the price up, but there is more pressure that is trying to test a lower price. Then you have the shooting star, right? Shooting star simply tells you that the trend is about to reverse. The sellers are going to take over. Then you have the hanging man. Hanging man is also telling you that there's going to be a reverse trend. We have the evening doji star. We have the morning doji star. Evening doji star is preceding some breakdown, and we have the morning doji star. Then we have the armor. Anytime you see armor shows up, then that means the trend is about to go bullish and reverse. And anytime you see this hanging man, shows up, that means the trend is about to reverse. So when you start to look at charts, try to look at for some of these patterns. You get familiar with it. Some will recall more often than others. But the more you see, the more you can identify them, the better you understand what they are indicating, what they indicate on the charts. These are different kind of indecision pattern. So now we've talked about the pattern. Let me talk about indicators. This is where it's becoming more interesting. Let me talk about indicators. So for you to be able to trade the markets or trade, you first of all understand your market structure, which we have talked about, your candle pattern, your cycle, and your resistance and support. But now you need to also understand your indicators. And there are four types of indicators, or four categories, not four types, four categories of indicators. We have many types of indicators. We have thousands of indicators. These are statistical and mathematical models that have been drawn for years. So we have many types of indicators, but it can be divided into four categories. The first is trend. The second category is momentum. The third category is volume. And the fourth category is volatility. So every indicator, or there are indicators that indicate whether the stock is in trend, is going upward or going downward. it will show us the direction of the stock. Then the next set of indicators we want to have is the one that will show us the momentum, how fast or what is the speed of the movement. Then the next indicator we want to have shows us the strength of the movement. What is the strength? What is the volume behind this movement? And the next indicator shows us volatility, which shows us what is the range of the movement, what is the lowest or the highest that has gone in its journey. So anytime you are wanting to read the chart or setting yourself up for trade, you want to ensure that you have indicators that will show you the trend, the one that will show you the momentum, the one that will show you volume, and the one that will show you volatility. Now, the common ones that is applicable to our stock exchange, because not all indicators can actually be used in Nigeria Stock Exchange, but a very common one that has been stable proven over time and is used in most exchanges also all around the world. Under trend is 20 EMA. EMA is exponential moving average. That means 20-day exponential moving average. The second is 50-day smooth moving average. They are not the same thing. 20-day exponential moving average is a little more sensitive. Exponential moving average is a little more sensitive because it puts more weight on recent price. You know, it factored that into the computation of the average. Whereas the smooth moving average just take the average across 50 days. So that tends to be a little bit slower, a little bit more stable. But 20-day moving average is a little bit more responsive to changes in price and a little bit more let me say agile in its trend. So you want to look at both the 20 exponential moving average, you want to look at the 50 smooth moving average. Then there's what we call MACD, which is the moving average convergence divergence. You know, it shows you the trend as well as momentum. It's one indicator that shows you both. All right. Then we have alligator. Alligator is one indicator that I like and I use a lot, and that's why I put it here as well. Alligator also, there are different averages, but why I like it is it tells you when the alligator's mouth is open. That means the market is in uptrend. Alligator is ready to eat. Alligator is hungry. When alligator's mouth is closed, that means that stock is entering consolidation phase. And when alligator's jaw is down, that means the market is going down. So I like it at a glance. I can easily see whether that particular stock is hungry, whether it's consolidating or whether it's going down. So I add it to the trend indicators. So it doesn't mean that you have to use all the indicators, but you will select the ones that is most suitable to your trade pattern, the one that you feel more comfortable with over time. But it's generally advisable if you are using 20 EMA, use it along with 50 SMA. All right. And I use 20 EMA, I use 50 SMAs, and I use alligator most times. Now, when it comes to momentum, there are many types of momentum indicators as well, but the three popular one is RSI, and we have William percent R, and we have stochastic, right? So I use RSI and I use William percent R a lot. You know, the three of them will show you almost the same thing, and so you can decide on the one you want to use and the one you are comfortable with. We will see them in other slides how to use them. Then we have volume. You know, most times when we log into our brokers page, what we see is we see the total offer and the total bid is kind of telling us about the volume. So, but there are indicators that will tell you about volume. We have OBV, which is called unbalanced volume. We have volume surge. We have money flow index. These are just indicators to tell you about the volume that is behind that particular stock. Then we have volatility. So for volatility, the two main ones, there are other ones, but the two main ones are ATR and Bollinger Bands. So I use ATR a lot. Now, this ATR is what will be used to compute your risk per share. I talked about risk per share earlier in earlier slide. So now, when you know the ATR, you can use the ATR to compute, because the full meaning of ATR is average true range. So he has calculated the average range of that stock over a period of time. So with that, you can use that as your risk per share. So we see how we can use that. Now, this is 20 EMA and 50 SMA. maybe in another session or maybe on a one-on-one session, I can put you and others through how to actually set all this thing up. But assuming that this is my chart, I pick a particular stock. I've put two trend on this chart. The first one, the one in blue, is the 20 EMA, exponential moving average, and the other one is actually the 50 SMA, 50 smooth moving average. So when I look at this now, anytime I look at my candlesticks trending above the 20 EMA, I know we're in upward trend. We know we're an upward trend, so it's still bullish. But the moment you see your candlestick going below the 20 EMA, then you know that you are in a downward trend, a bearish trend. Sometimes it might be below 20 EMA, but still above 50 SMA. That simply means you are still in upward trend. Maybe you just have some pullback, as long as that 50 SMA has not been broken, then you are not in a bearish trend yet. Okay, so that's how you use your trend at a glance to know whether this trend is bullish or is bearish, or we are in a pullback or we are kind of consolidating. So that's 20 EMA. So it's a trend line. It's an average trend line that you put on your chart. You need to see how that chart is doing. Then the next is the moving average convergence divergence. And what this does is it looks at the difference between the 26-day period EMA and 12-day period EMA, right, to plot a line called the MECD line. Then you now plot another line with a 9-day moving exponential moving average, which is called the signal line. Then depending on what the signal line does with the MECD, you can say whether you are in a bearish momentum or we are in a bullish momentum or crossover. Then we have the alligator, which is one of my favorites. So alligator use 5-day smooth moving average, 8-day smooth moving average, and 13-day smooth moving average. And what that does is it helps you to visualize where the trend is, whether it's also upward trend or downward trend. So we describe the 13 smooth moving average as the jaw of the alligator. We describe the 8 SMA as the teeth of the alligator and the 5 SMA as the leaves. So anytime the leaves is above the teeth and the teeth is above the jaw, that means the alligator is hungry. We are in bullish trend. But if the leaves goes below the teeth and the teeth comes below the jaw, that means the alligator is closing. And if the three of them almost merge together, that means alligator is sleeping. We are in consolidation phase. Alligator is sleeping. He's tired. So I like it because using the animal, I can easily understand what is happening to the stock. You can use all of them. You can use one of them depending on your preference. So what I do is I use 2050 on the daily chart. I use alligator on the weekly chart. So with the weekly chart, I will see what the alligator is saying, and on the daily chart, I use 2050. The two of them should actually be pointing me towards the same direction. Now, so momentum indicator. Momentum indicator, I have the RSI, which is the relative strength index. So this is an index. This is just a number. This is going to tell you whether a particular stock is overbought or is oversold. Sometimes people keep buying and buying and buying, and we overbuy a particular stock or we oversell a particular stock. So you as a trader, you want to know whether this stock is being overbought so that you know how to trade it or how to get out of it, or it's being oversold so that you know that, okay, there's going to be a reversal. And it's a number. Once you add this indicator to your chart, it's going to give you this pattern that you see below here, the overbought region, the oversold region. So it usually moves between 30 and 70. So anything between 30 and 70 is good. But once it's getting above 70, that means there's a potential sell coming because people have overbought. And anytime it goes below 30, that means they have oversold. There's a potential buying upward trend that's going to happen. So you want to look at this. This together with your trend indicators give you some kind of confirmation of the strength of the momentum. So we have Williams percent R is also telling you the same thing, but its own indicator is between -20 and -80. So anything between 0 and -20 is overbought. Anything between -80 and -100 is oversold. So you want to play in between -20 and -80. And the same thing goes for stochastic oscillator. Stochastic oscillator move between 80 and 20. Similar way you read and interpret Williams percent R, or you interpret RSI. You interpret this one too. So you pick whichever one you are comfortable with. I usually use Williams percent R and RSI. I'm kind of comfortable with that. Then for volume indicators, we have unbalanced volume. It also gives you an indication of what the volume is doing. We see it in read display. Then we have the volume indicator surge. It also tells you when you look at volume, you see where volume is low, where volume is surging, where you have high volume, and we have climax volume, and you have another volume surge breakdown lower. When we talk about Access Bank the other time, I said we can add another indicator to really understand whether the consolidation is accumulation or distribution. So by the time you look at the volume around that particular period, you will know whether they are actually accumulating, whether buying is going on. If your volume is peaking, is gradually going up, that means there is gradual accumulation. All right. But if your volume remains averagely the same, that means there's no real accumulation going on. It's just some exchange of, some kind of retail traders don't really move stock that much. It's the institutional players that really move the stock. And when they come into play, you begin to see it in volume. You begin to see some volume spike or high volume, increasing high volume or low volume, you know. So that's about volume surge. Then money flow index also just give you a number to show whether a share is particularly overbought or oversold. All right. I think we'll soon round up in the next 10 minutes. I started 5 minutes after 8. So
Okay.
now on volatility, we have what we call ATR, average true range. This number gives you an indication of what the range of the price has been within the period, usually 14-day period. And you can use this number to calculate your risk per share instead of just assuming it's 10% or 5% or 1%. You can follow this. And now we have Bollinger Band is similar as where it looks at 20-day period, then put some standard deviation, 2-day above and below, then kind of form a channel from which you can determine your volatility, how volatile that particular stock is. Now, we've talked about indicators. Let's now talk about strategy. There are three key strategies that we highlight in this presentation, which works well with Nigeria Stock Exchange. It works with other stocks as well, but there are different types of strategies. The first one is bull flag momentum. So anytime you see upward trend with some pullback and upward trend again, it easily form a bull flag, and there's a way to trade that bull flag. So anytime you're looking at the chart, you want to ask yourself, what kind of strategies can be at play here? Is it a bull flag strategy? So for example, if you look at this stock, somewhere here, you see that the trend is coming up here, but somewhere here, it forms like a pole of a flag. Then this pullback forms the flag. Then you know that after this flag, the next breakout is going to be upward trend. Then you want to trade based on the bull flag strategy. Now, and what's the setup for the bull flag? You want to identify the pole, you want to identify the flag, you want to draw your trend line, and you want to wait for a breakout that shows that it's going back up. Then you want to enter and buy. So the next strategy that works very well is moving average trend trading, where you look for your 20 EMA, you look for your 50 SMA to determine your buy zone, look at your resistance and support and pick a point where you want to trade and make your trade. So the moving average is also something that we use a lot in Nigerian stock exchange environment. And you see here, you plot your trend line, then you make your move based on the trend line that you plot. It doesn't mean that your trend line should be only 20 and 50 moving average. That's just the generally used. You can have 200 day, you can use, sometimes you have 52 week. That's like a year. You can decide to choose a year. You can set orders on your trading chart. Then the third strategy we use often is also opening range breakout. That is, you look for the opening range, the highest price that occurs between the first 30 to 60 minutes when trade opens. That will give you some sense of direction, whether it's going up or it's coming down. Then based on that, you can set your price for the day. These are some of the things that we do intuitively when we log into our broker's page and we just look at price and say, okay, I want to buy at this price. But there's actually a method to and to trading these stocks. Then we have different patterns. So get used to this kind of pattern. The head and shoulder, the inverted head and shoulder tells me about the bullish pattern. Head and shoulder tells me about the bearish pattern. We have the double top, which is also a bearish. We have double bottom, which is so. The more you look at them, the more you get familiar with them, the better you're able to interpret them once you see them. You know. All right, so let me quickly run through what is recommended generally as trading management strategy, which is to determine your position size, to buy maybe 50% at first entry. Then when you see that the trade is going in your favor, you can buy the remaining 50%. Then have your target, first, second, or third target. So when your first target is met in terms of profit, if it's 10% profit, that is your first target. Once that 10% is met, sell 20% of the target, then move your stop loss up. Then when the next target, maybe 15% is met, you set the next one before you set the final one. These are personal approach. You can tailor your own approach to however you want your trade to go. You can sell everything at once and move on to the next stock. Okay, so how do I know that a stock is in play? So you want to watch out for the fresh news. You want to watch out for the volume that is behind it. You want to look at what are the pre-market activities, what is the volume, what is the breakout levels, what as the 20 EMA and 50 SMA is doing. Is there any momentum around the sector, maybe banking, telecoms, and all that? Is the chart very clear in terms of structure? Then you want to know that, okay, this stock is in play. Not all stock will be in play. Some will not give you any structure on their charts, so you can't trade them. Then you want to check their market capitalization. What is their float? Float is the amount of stock that's available for trade. Market capitalization is the total shares the company has times their share price. So we have the low float company, we have the medium float, and we have the mega float. Usually you want to trade those that are medium float. Low float might be a bit risky, because you might not have the volume to be able to complete your trade when you need to sell thereabout. A mega float is very expensive. You might not have all the capital. So you want to play around medium floats. But if you must play mega float, maybe like some stock like Seplat, you want to really be sure that it's going to be in your favor, in your direction. Then we do have what we call opening gaps. Sometimes a particular stock closes at a particular value. By the time it opens, it's different. It's opening at a different price. Say, for example, Zenny closing at 125 and opening at 127. Some things happen after the session closes, and they can make adjustment for the price. So you want to watch out for that as well. Now, putting it together. So if you're now wanting to start uh, trading tomorrow, let's say the next day, what should you do actually? Define your risk first, scan for your stock in play, mark your levels, wait for clean setup, plan your entry and stop target, calculate your position size, execute, manage your rules, exit with intention. That is when your pattern is met, just exit and review your trade. But to make it easier, AI has made our life easier. Before, in those days, you will read all these things by yourself, you start to use the tools to. But these days, you can actually use AI to help you with analysis, not the retrading, but to help you with analysis. And also because of the constraints that we have around the platforms that our brokers provide for us, we might not be able to do a full AI automated trading, right? But we can use AI to assist with analysis while we not place our trade. So this is something that I've been using, that I put together, that it can also be reviewed and built on to do your trade. And what do you do? The first thing is to uh is to check the market and draw a list of the stocks you want to be trading. Draw a list of your stocks, your watch list, Zenith Bank, GTCO, Access Bank, all the stocks that you think you want to trade or you can trade. You put them in your watch list. It can be 10, it can be 5, it can be 20. You put them there. Then you want to identify their trend. Which one do I want to trade this month? Am I going? You don't need to trade all the stocks. So when you look at their pattern, you look at their structure, you can say, oh, I like to trade maybe two banks. I like to trade cement. I like to trade this. You select from your wait list based on what the trend is saying that, okay, there's possibility around this. So the next thing you want to do now is to do your setup. This is going to be another session entirely on how to do setup. I use investing.com's website to do my setup, right? I just started using trading view as well, but I use investing.com more. So you do your setup, your trend indicators, your momentum indicators, your volume indicators, your volatility indicators. Then you visualize and be comfortable with your setup. So once you do the setup, you have your setup for the stock, a particular stock, take a snapshot of it. Do for the next stock that you want to trade, take a snapshot of it. Then all the snapshot that you have taken, then you can now put it into your AI engine, whether you are using cloud, whether you are using ChatGPT or you're using Copilot or whatever other AI tool that is out there. Then you can give it a prompt. So the prompt I use, which I put here as a suggestion is, say, I'm looking at, you attach all the snapshot that they have put, right? Now say, I'm looking at the attach XYZ PSC Nigerian chart. The left chart, I use two charts. The left chart is daily chart, while the right chart is weekly chart. Identify if it's an uptrend, pullback, breakout, consolidation, or no setup. Determine the exact buy zone, stop loss, position sizing, profit target, total exposure, and risk reward using 20 EMA, 50 EMA, RSI volume, and ATR on the daily chart, and William Alligator, William percent R, and ATR on the weekly chart with an account of state the amount that you have in your account, 400,000, 500,000, 1 million, and create a table to contain the trading plan for the stock and recommendation that optimize reward as a practical trading plan for the coming weeks and include trading charts. So once you craft your prompt properly with all the indicators that you have put in that chart that you attach, just push it to AI. It's going to generate all the analysis for you based on the chart that you attach, which you have snapshot and you put there. Then review whatever report AI generates for you. Then decide if it's what you want to trade or select the one you want to trade from the one that you have prepared. Then prepare your trading plan. So what I do is put all those things in an Excel, you know, kind of. Then you know that becomes your trading plan. Then the next thing is now go on your broker's platform to place order, set your stop loss, and set alert. You can set alert on, I use investing.com to set alert. So you can prompt me when the market's reaching that particular price so that I can go back into my broker's platform to either sell, or to buy or whatever I want to do. But there's some portal that allows you to set your stop loss, but we don't have many of them around. So whichever uh, approach you use, what's important is just make sure that you have an alert that can tell you what the price is doing while you keep doing other things during the day. Then what you want to do once a day, just log in to check your trade and see how the charts are going, how the momentum is going. You can also ask AI to help you prompt you on what a particular stock is doing by time based on what you have the trades that you have set up for yourself. And the next thing is when you hit your stop loss, exit, don't mind the loss. If you hit your target, sell and start selling. You can sell it once, you can sell it in bits, and take your profit and jot down whatever your strategy is that you have used for that particular trade. I put some caution here. AI should not tell you what stock to buy. It should not replace your judgment or your discipline or your risk management. It cannot make emotional decisions for you. It cannot guarantee your profit. AI is simply your co-analyst, and you are the trader. You are the one that is putting the money down. So you do your trade. Let AI handle the analysis for you. Right. Lastly, Nigeria stock market, we know it uses automated trading system, so we can do trading online. We have brokers that we use, there are regulators that have oversight over all this, and there's price movement rule. If you look at some of the rules, 9 to 9:30 is when the market actually pre-opens. Some activities take place that time. Then from 9:30 to 3:50 is open to all of us for continuous trading. Then from 3:50 to 3:55, they have a pre-close activities and they publish the price for the day. Then 4 o'clock, the market closes. We have circuit breakers. A stock cannot go more than 10% plus or negative for the day. And we have market orders, we have limit orders, and we have stop orders. Some of the orders we have direct access to on our portals. Some we might have to send instruction to our brokers to undo for us. And we have the settlement T+1 that has recently been implemented, which means that if you sell today, you get your money tomorrow and you get your share immediately. So lastly, I say trade the process, not the prediction. Never risk more than 2% of your account on a single trade. Let scanner and set us find the stock. Let price action confirm the entry. Master a few strategies, bull flag, moving average trend, ORB, opening range breakout, rather than chasing every pattern. Review every trade and adjust your rules slowly based on patterns and not single outcomes. Discipline turns knowledge into result. Trade your plan. So that's all I want to present to us about technical trading. It's a lot. Just need to take time to go through it, understand the basics of the market structure, the basics of indicators and strategies, how to do risk management and account management, then start trading. Little by little, we make mistake, we learn from it, and we understand the process. It's actually an interesting thing to experiment or to try out over and above just investing in the stock market. All right, thank you for attending. I will make the recording available to others as well.
Thank you very, very much.
Okay, you're welcome.
Very much. Um, okay. Can I